Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Mathew. Mis-selling. It's a problem that a lot of us face, particularly in one particular segment of the financial market, and that has to do with life insurance. A lot of the time, you are sold a product that doesn't necessarily work for you. It doesn't fit your requirements. It is sold because there is a considerable incentive for the person who is selling you the product. We're going to talk about the various ways in which insurance is currently missold so that you're aware of what questions you need to ask the next time you are or next time somebody attempts to sell you these policies. And also we'll talk about a few other data points that will put this into a very sharp light. Joining me in studio today is Kanan Bahl, who's the founder of FinGrowth. And Kanan, you've done an interesting report. You've taken data from the annual reports of various life insurance companies, and you've tabulated a lot of anecdotal evidence as well. So let me start, before we get into some of these data points, on the ways in which mis-selling takes place primarily. And the banking channel route is something that even the regulators are now looking at very closely because there are issues with regard to how some of these policies are being sold. So in your opinion, first of all, thanks so much for joining me. What are the top ways in which these policies are missold?
So first of all, if I have to particularly talk about how policies are missold by the bank RMs, first is that it is not told that the person who is supposed to pay the customer has to pay the premiums for not just the first year, but the subsequent years as well. So what happens typically is, like, I have met hundreds of people and helped hundreds of people with their personal finances. And this is what I've realized, that people are not told clearly that if they don't pay in the second year or the third year, all of the money that they've invested will go in vain, because there's zero surrender in certain policies.
And which policies are these?
So these are typically traditional endowment policies which offer a fixed return. And fixed return, if you look at it on an IRR basis, it's abysmally low. It's like around 5 to 6%.
So IRR is internal rate of return. Apologies, I'm cutting you, because we have a rule on this show that we try to avoid abbreviation. So internal rate of return would essentially tell you over the course of the life of that investment, what is the amount of money that you're getting per installment, or putting all of those installments together, right?
Correct.
And where does that stand?
So that stands at close to I have not seen any policy which offers more than 6.2% returns, but I've seen many policies which offer as low as 3.5% returns, even as on date.
Okay.
So I don't understand how that makes sense.
So let's talk about that at a future point. But let's first talk about this issue, which is that your relationship manager or the seller of this policy is trying to sell you a traditional money-back policy, as it is called, and they are not telling you that the premium that you have to pay has to be paid on an annual basis.
Right.
And the issue with that is that the first year, the premium that is paid, a large portion of this premium goes as commissions.
Yes.
So, and that is tied to what is called the expenses of management, is it not? Can you explain that?
Yeah. So expenses of management covers a lot of things, which includes the commissions. So higher the volume, higher the commissions for the agent. Now, which could be the biggest agent? Which agent could bring possibly the biggest volumes? It is the bank. So it is in our mis-selling menace report where we found out that banks make hefty commissions. Like top 15 banks made 21,773 crores worth of commissions from selling third-party products.
During what period?
Just 1 year, financial year 24.
24?
Yes.
Just 1 year?
Yes.
Okay.
So, yeah, like I was coming. So, the incentive to sell an insurance policy by lying, by deceit, by whatever manner possible is so high, because if the customer is investing their life savings, I've seen cases where people had just 5 to 7 lakhs of their life savings, and they were told, this is going to be liquid. You don't have to worry about it. You can withdraw it anytime. You just have to pay it one time. You don't have to pay it over and over again. Like, this point wasn't told at all, that it's going to be paid. It is supposed to be paid over the years. But it was supposed to be paid over the years. And the risky part about this policy, such policies, is that you can't get your money back if you don't pay the second year premium or the third year premium.
Karan, is there any insurance policy, any life insurance policy where you only pay 1 year of premium?
Yes, there are.
Which is it?
Single year premium policies are there.
Okay, and how do they work?
So how do they work is typically that you just pay in the first year, and whatever benefits are designed according to that scheme, you get paid according to that. So in that case, you just get paid, you just have to pay for the first year, and then whatever benefits that will accrue to you as per the policy. But again, that doesn't necessarily mean you can withdraw them as and when you require them.
Sure.
There are terms on that as well.
Okay, so we've talked about wrong information about the payment terms, and we figured out which questions to ask. But let's talk about another aspect, which is being sold the wrong product in the first place, and wrong information being given about a product. Often people walk into a bank branch and they get sold a ULIP policy or a ULIP, a unit-linked insurance policy, and they don't know what it means. They think that it's fixed return, but it's not. Is this the most common instance?
This is one of the most common instances where people are projected that you can make 12% returns, and that is based on the benchmark, say the Nifty 50 index or the Nifty 500 index or whatever the relevant benchmark is. But that is the benchmark, right?
It's not the underlying, it's not the actual portfolio.
Right. And if you look at the expenses that are there in a ULIP versus a mutual fund also, they are vastly different, right? ULIP comes with heavy charges. Mutual funds are allowed to charge a maximum of 2.25% expense ratio for a very small fund size. Whereas 2.25% of expense ratio in a ULIP comes at the 10th year.
Wow. Okay. So let's explain this in an example, right? So what is a normal premium to pay in a ULIP that an average person would pay? How much of that premium actually goes into the investment in the first year?
Right.
Let's break that down.
Sure. So like I was saying, it was the 10th year, right?
Yeah.
It's not even the 10th year, it's the 15th year, sorry. Right? In the 10th year, it's still 3%.
Right.
That's the maximum a fund is allowed to charge. A ULIP fund is allowed to charge. So while in mutual funds, you just have one expense ratio, that is total expense ratio, nothing beyond that. This is the maximum that a customer can be charged. In ULIP, there are a plethora of charges.
Okay.
First one is the fund management charge, which is 1.35% on a trail basis. It means that whatever the net asset value of the customer is, the ULIP, the company, the insurance company can charge 1.35% maximum on account of fund management charge.
Right.
But that's one charge.
Yeah.
Then there's premium allocation charge, which is capped at 12.5% of annualized premium charges.
Right.
Then there's a guarantee charge. That is, currently it's a maximum of 50 basis points, that's 0.5%. Policy administration charge of 500 per month up to 500 per month. If you surrender or if you discontinue paying premiums, then there's surrender and discontinuance charge. Then there's switching charge if you want to switch between asset classes or things like that. Then there's rider charge or rider premium on rider premium. Then there's partial withdrawal charge. Then there are miscellaneous charges also that are capped at 500 per alteration, right? So it comes with a plethora of charges. And the IRDA has maintained that in the 5th year, you can't charge more than 4% of expense ratio. Like the difference between the gross yield and the net yield can't be more than 4%. So this includes commissions as well. This comes to 2.25 in the 15th year and onwards. But until then, the customer has to pay heavy commissions.
And what you were pointing out in that 80%, what we were saying expenses of management. So if I'm paying a premium of 1 lakh in a year, you're saying 80,000 of that can go as commission. Is that what you're saying?
Not exactly as commissions, but I'll give you an example. So this one was for ULIPs. ULIPs are typically market linked. Those are non-market linked products. They are fixed income products, typically fixed income products, wherein say if you're investing 1 lakh in the first year and your premium payment terms are for 10 or more years, then the insurer can charge on account of expenses of management up to 80% of the first year premium. That is 80,000 rupees. Now this 80,000, a large part of this may go towards commissions. So even the topmost of life insurers pay up to 50-55% insurance commissions in the first year to their agents. The maximum volumes are driven by banks, and we have spoken with a lot of bank RMs in a survey that we did last year. they told us that their bank makes up to 65% commissions on the first year premium.
Okay, so
that's
it's very large. It's very, very large. So that's something to bear in mind. There's incentive to sell products in a big way. False promises are made of extra benefits. You've come across this. Give me an example of this.
Yeah, so like, it's bundled with various products. And say, for example, if you go to take a home loan, it is a 1-month process where you arrange for the documents, it goes for underwriting, there's physical underwriting, and verification of your land, etc., property papers and everything. And then when your loan gets sanctioned, you're told that you'll have to buy an insurance policy, which might be as high as 4% of your loan amount.
But why is that?
Why is that? Because they make commissions. And if you don't buy that insurance, sorry, your loan application can't be passed. And they tell you just before the registry date, because you can't go back on the registry date. Your seller might get pissed off and they might go to sell it to another buyer, right? So you have to succumb to that pressure. People don't know this.
Right.
So when I was doing this thing, when I was helping my friends with this stuff, I told them apply with 2 to 3 banks.
Yeah.
Otherwise, they might coerce you into buying a life insurance policy which is not suitable for you at all.
And in that, of course, when you're buying a home loan, it's considered a good idea to have a term insurance policy because of the size of the loan.
Right.
And you don't want to have that liability pass on to somebody else, which is fair practice.
Absolutely fair.
But you should do that separately. You shouldn't necessarily have to buy from the bank where you're taking a loan from, right? So, and that's something to bear in mind. Okay. They're sold only as tax saving or investments. I've actually experienced this myself. The person who's selling the policy comes to you and says, hey, we've got a great tax saving product, but hopefully this goes away, Kanan, because a lot of people have moved now to the new tax regime and you don't get any benefits anymore from deductions, right?
Of course, you get on the maturity, it's not taxable, but even now there are caps on how much fresh investments you can make in a life insurance policy, which would be tax-free. So if you're paying premiums worth more than 5 lakhs on an endowment policy, which is issued after, I guess, 1st April 2023, it's not tax-free. Its maturity proceeds are not tax-free. 90 to 95, it is as per the Ministry of Finance's, people's statement that I'm quoting them. 90 to 95% of people are now going to opt for the new regime and there's no ATC over there.
Sure.
So you're not going to get any tax break as far as the investment is concerned. Returns, again, like I said, if you're making more than 5 lakhs worth of investment, it doesn't make sense.
Yeah. So if your annual premium is more than 5 lakh rupees, then it becomes a problem in terms of the taxability of it, right? Okay, so we've talked about several ways in which these policies are missold. So the purpose was so that you can ask the right questions when you get introduced to some of these products. But there's also more data that has come through, and Kanan has actually gone through the annual reports of a number of life insurance companies to find out the surrender, withdrawal or discontinuance or lapse policies. This is essentially when you stopped paying the premium towards a policy, you've surrendered the policy, you get back a certain amount. So first, before we get into some of the data points, let's identify how much you get back, because there were regulations recently that talked about this. How does this work? It's abbreviated for practical purposes to SWDL.
Yes.
How does this work?
So I'll give you a very simplistic example, and I would oversimplify it so that people can understand and grasp this concept, right? If you have to pay, say for example, if you could pay premiums for the first 3 years, you get to know that, okay, I have to pay for multiple years, but okay, beyond the 3rd year, I just can't pay it. Even then, you get just 30%. I'm just giving a hypothetical example over here. You get just 30% of your premiums that you've paid so far returned back. So if you've paid 3 lakhs, you get just close to 90,000 rupees.
Right.
So you see the wealth destruction that has happened over here. That is worth 2,10,000 after paying 3 lakhs cumulatively over 3 years.
But what's the rule?
The rule, so while what I'm saying is as per the rule only, it's complicated to explain, like it comes on a, like surrender value norms are there, but what I'm saying is correct only. Like as far as endowment policies are concerned, if you pay only until the 3rd year, you get 30% back. Of course, it depends on policy to policy, but for the sake of simplicity, it is correct that you get 30%
roughly
back.
30%.
30% if you don't pay beyond the third year, right?
And if you pay, for example, if it's a 15-year policy, if you paid 6 years or 7 years, and then
it increases. The
amount that you get
30% increases. The percentage does increase, right? But say, like I'm giving you an example, you get just 90,000 back. 2,10,000 goes waste of your investment. Why? Because all of that has gone towards commissions, towards expenses, and the balance that gets left with the insurance company is their lapsation profit, right? While it is not possible for us to calculate the lapsation profits, we'll have to only estimate it, and we are working on that. But as far as this ratio, that if we are going to talk about this later on in the show, this ratio will completely, scare you as to how much of lapsation
why don't we
profits.
talk about that?
Sure.
You've actually tabulated the percentage of total benefits paid. So let's identify what this is. Total benefits paid would also include, by my understanding, claim settlement also that takes place, right? So
absolutely.
suppose I've taken a life insurance policy from XYZ life insurer, and for whatever reason, my family is claiming that life insurance. The entire corpus, 1 crore, let's assume, that 1 crore has been claimed, and that is included in this total benefit.
Right.
So what you've said is, for the top 10 life insurance companies, this is again for financial year 24?
Yes.
So for the year to March 2024, what Kanan has found in the annual reports of the top 10 life insurance companies is that 43.3% of the total benefit has actually gone towards the payment of surrender, withdrawal, discontinuance, lapse, which is startling, is it not?
Absolutely.
So what does this tell you? It tells you that this is, first of all, roughly 30% of the premium that has been paid over a period of time. And so therefore, it is representative of a much larger amount.
Right.
Is it not?
Absolutely. So, like I said you, that this 90,000 number is coming in this column of SWDL in rupees crores, right?
Yeah.
The wealth destruction is invisible over here.
Yeah.
It gets somewhere, included in the profit after taxes.
Right.
But as far as this ratio is concerned, you see how much significantly is being paid towards these policies which are either surrendered. I gave you an example of surrendered, then discontinued, withdrawn, lapsed is a different term, right? But this gives you an idea how many people are actually paying for their policies beyond the first year, second year, or the third year. The average persistency ratio of top 10 life insurers based on the number of policies issued is just 51%.
What is a persistency ratio?
So
how do you explain it?
So if say for example, I have a policy where I had to pay premiums for say 6 years, right? So am I paying it in the 61st month as well? Is my persistency ratio. So when I say the persistency ratio for the top 10 life insurers is just 51%, it means that 49% policies, there were 49% policies which the life insurers issued were not paid upon by the customers.
So they didn't complete the whole term?
No.
Okay. So, but is there any ratio as to at what point did they drop off?
So there are different, so these persistency ratios are available for different intervals.
Sure.
The first one that we get is the 13th month persistency. Then I think we have the 25th, 37th month. So 1, 2, 3, 4 years and so on. So on and so forth we go.
Yeah.
But there's no data available after the 61st month.
Sure.
So I have the data for the first, I have collated the data for the 13th month persistency ratio.
And that's 51%?
Yes.
For the 13th?
Not the 13th
For
month.
the
That
61st
is close to
month.
20%.
Right.
That 20% policies are not continued beyond the first year. That's close to 20%.
Yeah.
For 5 years, 49% policies are not paid upon.
Wow.
Yeah.
Okay, so that's a considerable amount. And that then builds into this surrender value that is being paid out on a yearly basis.
Correct.
Okay.
Now, this number of total benefits paid includes the SWDL ratio, and it also includes the benefits that, for example, say if someone died, is getting out of that policy, their family members are getting out of that policy. It also includes the investment maturity proceeds that someone who completed their life insurance policy term are also getting.
Yeah.
So that is there, which is also abysmally low, right? But otherwise, you look at the extent of wealth destruction that's happening.
Yeah, because you don't get your principal back.
Correct.
So the most important thing, and also, it goes without saying, you actually pointed that out early on in the program as well, where you talked about traditional policies and not ULIP. ULIP, I think a lot of people have bought over the years because of the tax angle, and with that tax angle now going away, of course, the maturity proceeds are still tax-free, which is great for people that have bought below that 5 lakh mark.
2.5.
Right?
For ULIPs, it's 2.5
ULIPs
lakhs.
is 2.5. Okay, so which is why people have continued to buy that. Hopefully with that disparity going out of the window, that reduces as well. But the returns that you get compared with a traditional policy in even a provident fund or public provident fund or
right.
A fixed deposit in certain situations is actually higher. So that actually drives home the point. Kanan, I think we've spoken about something that is very important, and hopefully this will help a lot of people out there when they go to their banks, or if they are approached on a telephonic conversation to buy certain products, they know what questions to ask.
Absolutely.
So thank you so much for doing this conversation.
My pleasure.
All right, there you go. So if you've got specific instances where you've experienced mis-selling of insurance products, write to us in the comment section and we'll take it up.